Let's talk about what's on your radar. How closely are you watching the banks?
Good morning. I am watching two things. I am watching the banks because I am overweight the banks. So I'm really excited about earnings next week. Next Wednesday, it all kicks off. But I'm also watching this rotation, as you just mentioned. It's been a kind of a quiet week, Dom. But under the surface, you have had this massive rotation back into growth away from value. But I think it's more mean reverting, to be honest, because the first quarter was all about value and it was all about banks and industrials and energy. The XLK is up 7% year to date, but energy is up 28% and the financials are up 18%, and industrials are up 13% year to date. So tech can make a comeback, but I do think these other sectors are still very attractive because the economy is getting better. You mentioned what I'm looking for next week. We have JP Morgan, Goldman Sachs, Citigroup, Morgan Stanley, Bank of America. I think the bank stocks are going to do very well next week in terms of net interest margins, capital allocations, and the valuations are still attractive, even though they've made such a big move. So I like the banks this year, and I think even though they've had a nice move, again, I say the valuations are pretty attractive, and now you actually have some interesting dividend yields too.
The Fed is kind of loosening the reins. The Fed is loosening the reins on some of these banks to kind of return capital to shareholders in a more meaningful way in the coming months. Stephanie, many of these banks have diversified operations, but are there certain parts of the financial sector that you think are better positioned? You mentioned net interest margins. Do you think it's the traditional lenders that outperform in banks? Do you think it's the capital market intensive ones like Goldman or Morgan Stanley? What's got your attention the most within that kind of bank sphere?
I mean, I think you just hit it. I think it's both. With the yield curve actually getting steeper, you're going to want to own something like a Bank of America, which has the most exposure to a yield curve steepening. But at the same time, trading and capital markets are on fire. So Morgan Stanley and Goldman Sachs should do well. I personally like Wells Fargo because I think it's a turnaround story while you see a yield steepening situation, right? And Wells Fargo it's a turnaround story. You have a new CEO. Well, he's not new anymore, but he's there a year and a half. He's got a whole entire new executive committee. The asset cap can get lifted at some point, which will be a catalyst as well. And the stock is trading at 1x book. So I still think that Wells is an attractive idea. I think people are still very skeptical about it and the turn. And that's where I think your opportunity is. And then one last one for you, Dom, is American Express. That's your reopening name, right? T&E is going to come back eventually. They're spending a ton of money this year in terms of investments. And I think that's going to reap rewards next year in terms of operating leverage. So that one I like as well.
I think, Stephanie, the value kind of trade that you mentioned, this idea of trying to find beaten up names, is something that resonates with a lot of our viewers and listeners out there. Are there other parts of the market that have not participated in the rally towards record highs that you think, because of their underperformance and depressed levels, could represent potential upside? I look at consumer staple stocks. They're some of the worst performers this year so far. Are there any names out there that you like?
Well, that's interesting that you mentioned that because Pepsi reports next week as well, right? And they've lost 3 multiple points relative to the group. The group has been under pressure as well, and it's also lost 1 multiple point on a valuation basis, on a PE basis. So Pepsi has lost more, right? And it's actually down about 3.5% on the year. And I think that'll be interesting to see how it trades when it reports. I'm pretty sure they're going to report a really good number. They always usually do. However, it is a stay-at-home stock, right? They've benefited from that. I prefer Coke because 50% of their business is on-prem. And so as you reopen, their business should actually get better. And they're both down about the same. By the way, Coke, you get a little bit better dividend yield, about 3.2%. But Pepsi will be interesting to see how it trades. I'm not a huge fan of staples. They aren't exactly cheap, but I do think that there are some pockets that you can pick away at within the group. Again, I mentioned Coke. I mentioned Estee Lauder. I like those 2 names a lot. Those are the 2 that I own.
All right, so I guess there's a very bullish undertone to many of the stories that you're telling right now. What exactly has got you scared the most in the coming 6 months?
Oh, well, I think I'm watching inflation, quite frankly. I'm watching how fast do we grow? We have all this stimulus. We have $100 trillion in stimulus globally that has been put in place over the last year. And we know, Dom, that it takes a long time to get stimulus into the system. And so I wonder, how fast are we going to grow? Are we going to start to see a little bit more inflation? I look at unit labor costs at 0%,
Sure.
and I worry that we can only go up, right, in that regard. So those are the things that I watch the most.
Shepard Smith here. Thanks for watching CNBC on YouTube.